Welcome to TheoTrade. This is Don Kaufman. It's June 11th, 2018. You are watching the Theo Night video. Let's get to it. Waiting on the Fed. Well, we're waiting on a lot of things this week. We're waiting on the Fed. We're waiting for news out of, the North Korea summit. We're waiting for Bank of Japan, the ECB, possibility of trade war. There's a lot that we're waiting on. And I'm going to start with this evening because it's just kind of a grinding day. And I'll tell you what, the volume out there is really, really light in the equity products and the index products. The S&P futures are seeing some volume, but that's predominantly because there's a roll going on, which I'll come to here in just a moment. But back over here to the VIX, because I'm going to start with the VIX. You guys know, so I don't look a tremendous amount at the VIX, but hey, listen, it is volatility related to the SPX. And you have to recognize at this point in time, the VIX for the most part is staring down the face of umpteen different announcements, and it's laughing at them. And again, don't look at it as, oh, the VIX has got to be wrong. Just look at it as a degree of opportunity. When I say the VIX is staring down the face of umpteen different, possibilities I'm talking about the Fed, right? So we have the Fed coming out on Wednesday, but quite frankly, we don't expect a lot out of the Fed. They're going to raise rates, yada, yada, yada. There'll be, a bit of a press conference thereafter, and we'll move forward. I really think that some of the curveballs that can be thrown this week could be, all right, Bank of Japan, which actually comes out on Wednesday evening after the Fed. Then, of course, we've got the ECB the next morning. There's always the possibility of a little trade war curveball being thrown in there. Again, there's a lot going on. The VIX stares at it, laughs. And again, we're going to be discussing this here kind of momentarily in really how we could take advantage of specifically that. Now, as I say, the VIX is rather low. So right off the bat, what does that really mean to you? So volatility, all right, in the VIX, that's really what it is, the volatility index. All the VIX is doing is it's measuring and it's calculating approximately what 30-day volatility happens to be. So if you take a look out at options that are approximately 30 days out, okay, they're usually fairly close to what the VIX is effectively trading at. And here's options that are 30 days out. Again, it's just an average of the out-of-the-money options, okay, through a 30-day time horizon. However, if we look in even the shorter duration, and this is an important point to kind of be made. So we're looking out here 30 days, and the VIX, it's 30 days out. Well, we're more interested in a day-to-day basis. What's happening in the right here, the right now? And in fact, if you do take a look, there is some additional volatility being priced in. All right, these are options that happen to expire, June 13th, which is none other than Wednesday. Then we've got a Friday morning expiration, a Friday afternoon expiration. And you can see there's a tiny bit of a bump in volatility. But for the most part, volatility in the here and now, that's volatility in the short duration, is almost identical to volatility further out in time. Nonetheless, okay, given the fact that the market is staring down the face of so many binary events, I am going to be looking to be a net buyer of options in the short duration, okay, and happen to be a net seller of options in a bit of the longer duration, because we just have a marketplace that there's too many events that can occur that can just create movement this week. And I don't want to sit here and tell you like, oh, I think we're going to move X or I think we're going to move Y. That's why they're called binary events, because there isn't necessarily any definitive relationship between, what you think is going to happen. This is a coin flip. That's why we call it a binary event. Heads, we're going up, tails, we're going lower. But that's in the short duration. Okay. That hasn't gotten me away. And people always ask me like, you still bearish? Okay. Yes, my bearish take, though, is much longer duration. Why do I have a longer duration bearish take? Because we're in a rising interest rate environment. But that's not necessarily what my take is tomorrow. That's not necessarily what I think is going to happen a week from now. Okay, my bearish stance, and when I say long duration, I'm 90 days, I'm months out, I'm years out, because again, a rising interest rate environment in a heavy debt kind of society, those two don't exactly meet very well in the middle, do they? So I'm actually going to talk a little bit in a moment here about buying some premium in the short duration. Before I do that, though, I want to take you over to the financials, because the financials, well, they're interesting me today. They're interesting to me because we have the bonds that are down. Not a lot, just slightly, but the bonds are down. And when the bonds are selling off even mildly, that takes the interest rates slightly higher. As the interest rates go slightly higher, you would think that the financials would benefit. And the financials, okay, this has been what's driving a huge amount of this recent rally specific to the S&Ps. Clearly, the Nasdaq has played a role in the S&Ps, but the S&Ps themselves, okay, they're not going to explode higher like this without the financials, okay, on board. And the financials, they haven't just stalled out today, okay? They've stalled out really the last 3 trading sessions, and they're weak on a relative basis. The other thing that really stands out, and again, this is where I'm saying the VIX isn't necessarily pricing in the risk, but the financials seem to be. If you take a look at the financial sector itself, okay, this thing is pricing big league movement throughout the course of this week. So the volatility here is double what it is in the VIX, right? So if you look at the VIX is sitting right around, what, 12? Here we're looking at like a 25 volatility on a 64-cent move. We're still expecting 64 cents of movement. And here's the interesting irony of that. If you look back to where we were this weekend, all right, all I'm doing is going into what we term think back. Okay, so I'm going to think back, and it's just showing the trade, all right, for June 8th. But in any regard, if you look back, this was the weekend, and over the weekend, the kind of volatility we had, 21%. I just want to show you the volatility now coming into Monday has actually risen ever so slightly. The volatility is going up. Again, what this is, it's almost like a crescendo for, well, there's going to be more risk. The financials are all about the risk right now. And I just want to give you a quick comparison. I did this the other day, but this one, it just speaks volumes. Look at the financials 4 days out, then go look at the Nasdaq. Because again, everybody's like, the Nasdaq is where it's at. Really? Because the Nasdaq only has 18% implied volatility. No, it's the financials right now that are going to carry the boatload of risk. Now, when I talk about selling premium versus buying premium, okay, I'm going to show you just a little bit of a construct of a trade, because we just did a course this past weekend on duration iron condors. And duration iron condors means that I'm out here some 60, 70 days and I'm selling options premium, okay? I'm not trying to collect a boatload of capital out there, but I'm selling options premium. Why am I so far out in time? I'm far out in time because, first of all, there's great premium to be grabbed 67 days out, and it's a slightly higher volatility climate. Allow me to show you over here in the Analyze tab, because I built a few trades for you. So I'm going to go ahead and I'm going to close up this left side bar, and there's just about 5 minutes left in the trading day, and the S&Ps are just grinding, all right? You know, just waiting for the Fed, waiting for the binary events to kind of hit, waiting for somebody to scream the word trade war. And, you know, that's where we're at. So what you're looking at right now happens to be, okay, an iron condor. And I'll even unlock the price and relock it. This thing is, listen, it's not crazy. You could also be doing this type of an iron condor instead of using the spiders and doing 10 contracts. You could use the SPX and use 1 contract, but the SPX is a high level of experience type trade. But the point I want to make with this is, you know, everybody assumes that you have to sell options right before expiration, but you don't. Okay, take a look. All I'm going to do here is I'm going to take this iron condor, I'm going to unlock the lock so you can see the price is right around 70 cents, okay, and 77, 78 cents. I'm just going to drop this to the July 20th, and I want you to see, do you know that over 50% of the premium comes out? Over 50% of the premium comes out. All I have to do, okay, is wait, what? Well, a couple of trading days. What's a couple of trading days? Well, for the most part, all I'm doing is going, and again, I'm going to go to the option chain so you can see this. I'm going from 67 days, and I'm just dropping to the July 20th, which is 39 days. There's not even 30, okay, calendar days packed in here. Right? There's a lot less trading days. We're talking about a handful of trading days, and effectively, you know, people think, again, far out in time, you can't sell premium. Sure you can. And again, over 50% of the premium that I can collect, all right, is in that first, you know, what, 20, 25 trading days. So that is me going out and selling some premium. And I would build a number of different iron condors. This just happens to be one. But in the short duration, I want to be a net buyer of some of the option premium. And when you start putting them together, it's like worlds are going to collide. But when you start putting it together, all right, this is where, you know, I don't think the risk graph necessarily does us justice. Okay. But in the short duration, I think the market really has the capability to move. In the longer duration, we're probably trapped within a given range, given the fact that it's summer. But this is the kind of trades that you want to start to toss around. And by the way, this is not a mistake by any stretch of the imagination. I'm selling 10 iron condors, okay, and helping myself finance just the purchase of like one straddle or a strangle. And again, all I want you to do at this point is not necessarily run out and fire off a bunch of trades, but to grasp the overall logic, okay? And that overall logic is in the very near term, we're looking at volatility and saying, wow, volatility looks incredibly low in the near term. Further out in time, yeah, you know what? For the next 30 days, I don't mind buying some premium. Again, we might be waiting around a little bit this week, all right? Waiting for some news to hit, waiting for some of these binary events. But again, there are trades, okay, to build. And right now, when there are this number of binary events, this is where I start to look towards market neutral trades, similar to buying and or selling premium on both sides of the marketplace. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.